What is the yield curve? And more importantly, what impacts the yield curve? Is it interest rates, inflation, government issued debt? This is part 2. Let's get into it. Quick review of part 1. The yield curve is made up of Treasury issued securities, which is just government debt. It's considered safety assets backed by the full faith and credit of the US government. It is auctioned with different maturities. They tell us in advance the auction size, date, and maturity. So for example, 150 billion, a 12-month or 10 years. And all of that makes up the yield curve. This is the important statement. When it's auctioned off, market participants are saying, I want this much yield for some reason. And that's why this is considered the risk-free rate, because you're very likely to get paid back. It's extremely low on the risk scale. So if you park your assets in US Treasuries versus parking your assets in the stock market, which is a bunch of corporations, this is your cost of cash. So if you expect more growth over there, because this is a little love triangle, you would expect more yield on the Treasury market to compensate you for that. Now hold on to that nugget as we go through this. This is a normal yield curve because the shorter term rates are lower than the longer term rates. We expect growth in this scenario. So we get 3 types of yield curves. The normal, that's growth is expected because we're being compensated for money over a longer period of time. If it's inverted, that means a slowdown is expected. And if it's flat, there's no or little growth expected. Normally this is stagflation is indicating, but that's why this always signals a recession. Let's dive into deeper as to why. Market participants or auction participants might be accepting lower yield from treasuries, or there's a flight to safety because it's considered a risk-free asset. So you have to understand the relationship between bond prices and bond yields. So if the bond is auctioned off as debt of $1,000 at whatever maturity, you're getting 5% for that. That's annual. That means you're getting $50. This is your constant. People are selling that bond. So they're going out of these risk-free assets. That's going to drive the price down. But since you're still getting 5% on 1,000, your constant, that $50 of 900 is 5.5. So that's what drives the yields up. The inverse is also true. It works on a seesaw. And this is all market mechanics. So now the question that remains is, what is driving those market mechanics? Here are some common factors. If you have demand for treasuries, that's a flight for safety. If that demand is low, so they're buying into the stock market, selling out of treasuries, that's going to put yields higher. But if demand is high, people are buying treasuries, then that's going to send yields lower because of this example. Right? If there's increased inflation expectations, so if we expect higher inflation expectations, that's going to increase yields because we need to be compensated for that. We're going to demand that in the auction process. But if there's lower expectations, then yields are going to be lower, because that should tell you if this starts steepening, which means it goes like this more, that means higher inflation expectations, and too much inflation is bad.